Ladies and gentlemen, good day and welcome to Q4 FY24 and Annual Results Conference Call of Alembic Pharmaceuticals Limited. We have with us today Mr. Pranav Amin, Managing Director, Mr. Shaunak Amin, Managing Director, Mr. R.K. Baheti, Director, Finance and CFO, Mr. Ajay Kumar Desai, Senior VP Finance, and Mr. Nilesh Wadhwa, Head, International Business and Strategy. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. R.K. Baheti. Thank you, and over to you, Mr. Baheti.
Yeah, thanks. Thank you everyone for joining our Concall. Let me briefly take you through the numbers, financial numbers for quarter ended year ended 31st March 2024. During the quarter, our total revenue grew by 8% to rupees 1,517 crores. EBITDA is rupees 263 crores, which is 17% of sales, and it grew by 29% on YOY basis. Net profit is 178 crores, grew by 17%. During the financial year, the whole year, revenue grew by 10% to 6,229 crores. EBITDA is 961 crores, which is 15% of sales and grew by 41%. Net profit is 616 crores, it grew by 80%. EBITDA and net profit for FY24 are strictly not comparable with previous year, as during previous year, that is financial year 22-23, expenses pertaining to new facilities were capitalized up to December 22, and they were expensed out only from January 23 onwards, whereas in the current financial year, the full expenses for full year have been expensed out. Also, there were a couple of non-recurring items in the previous year. EPS for the quarter is rupees 9.07 per share versus 8.33 for last year corresponding period, and for the year is 31.33 per share, 31.33 per share for the current year versus 17.40 per share after the non-recurring items, and before non-recurring items of previous year it was 25.29 per share. So I think overall we have done well in almost all parameters, and we'll discuss business-wise when we come to that. The company has recommended a higher dividend of rupees 11 per share, which is 550% because our share par value is 2 rupees, as against dividend of rupees 8 per share, which was 400% per equity share for financial year 22-23. As we have been indicating in last year or so, R&D expenses for the year has been trimmed down to 475 crores. Last year was 722 crores, but 722 crores also included one-off write-off of erstwhile Alios R&D expenses. As far as cash flow and borrowings are concerned, the company has generated a good cash flow of 900 plus crores for the year ended 31st March 2024. After meeting its capex as well as working capital requirement and payment of dividend, the net cash inflow was 436 crores. 436 crores are before paying dividend. After paying dividend, we could reduce our bank borrowings by almost 200 crores. So the debt equity, which was already pretty low last year, has become even lower. So our net debt now is gross borrowing is now 430 crores versus 636 crores last year, and we have 120 crores of cash in hand versus 75 crores in March 23. I think with this, I will hand over the call to Shaunak for his presentation on India branded business. Shaunak, over to you.
Yeah. Thank you, Mr. Baheti. So the India branded business in this quarter grew by 3% to 503 crores. And for the year, we had a 7% growth leading us to 2,200 crores in revenues for the year. The commentary for this is, I think, for all our specialty segments and predominantly in gynecology, gastroenterology, anti-diabetic cardiology, ophthalmology, we have done significantly well. The businesses have continued to perform well, and in many brands, we have continued to outperform the market. Along with that, our animal healthcare business has continues to give a very robust performance. The only challenge this year, as well as for Q4, has been the oral and the respiratory baskets, and predominantly in the oral liquids, in both antibiotics as well as in respiratory. Both these segments did have a significantly high base, both for the year 22-23 as well as 23-24. Sorry, 21-22 and 22-23, leading to a significant base correction effect, which we've seen for the market, and thereby pulling the overall growth of these segments down to almost like a flat or a negative growth. And despite that, we have done marginally better than the markets. But at the overall level, the impact of this was too large. I think going forward, we expect the base to be corrected now, and we expect even these two segments to give us more growth in line with the market. And with that, I think 95% of our overall portfolio in the India business should be doing pretty well and significantly outperforming the market in most cases. So now I'll pass the discussion on to Pranav for the international business.
Thank you. It was a decent quarter for the international business, especially the U.S. business, which grew on the back of 7 launches. The outlook for the U.S. business also appears much better than the start of the year, with the commercialization of new facilities and operations set to scale up. We also don't have any regulatory overhang and have all EIRs in place for all our facilities. Hence, we see some substantial increase in operating leverage, along with the continued progress in cost improvements. The ex-US generics were also satisfactory, as well as the API business, and they both, on a strong foundation, they continued growing in the quarter. As I mentioned, we had the EIR for our oncology facilities, and all EIRs are in place. R&D expense was 8% of sales at 121 crores for the quarter. We have been working at optimizing our R&D cost, and all improvements are on track. We filed 3 ANDAs during the quarter and cumulative ANDA filings at 260. We received 1 tentative approval and launched 7 products in the US during the quarter. Since April 1st, we have received 5 additional approvals, which include 2 tentative. As regards numbers, I said the US we launched 7 products and the business grew by 19% for the quarter, whereas for the year it grew 10%. The ex-US generics grew 5% for the quarter, but for the year it grew at a robust 23%. The API business grew 5% for the quarter, whereas 7% for the year. As I mentioned in the last quarter call, that API will see a couple of quarters, maybe a little slower offtake from some customers. But volumes-wise, the API business is still looking good. We cater mainly to the regulated markets, and there's some pricing pressure, but volumes-wise, API is looking quite good as well moving forward. Now, with that, I would like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask the question. The first question is from the line of Damayanti Kerai from HDFC Securities. Please go ahead.
Hi. My first question is on gross margin. So very strong margins during the quarter. So if you can explain what has led to this very strong gross margin during the quarter and how sustainable this would be. So that's my first question.
The gross margins were, thank you for the comments. The gross margins were good. I think a couple of things have led to this. I think one is increasing sales and revenue for the US business. Number two, if you saw, R&D costs were also optimized. Along with that, we had some other cost optimization. So all this led to a higher gross margin. I think all the businesses were growing, the facilities were better occupied. And I think, yeah, these kind of margins are sustainable moving forward.
Okay, just a clarification. So you said higher US sales could be one of the factors contributing towards it. But quarter on quarter, when we look at the gross margin, I guess US is sequentially down, right? So is there any element of like stocking up there?
No, I think no element of stocking. It just, I think last quarter we had maybe some more one-time buys, whereas this quarter I think the volumes were a little larger, volumes a little higher, so facilities were better occupied.
Okay, so better utilization of facilities is main reason if we have to continue.
Yeah.
Okay, thanks for that. And R&D, like after bringing it down to below 500 crore for this fiscal, how should we look at R&D expense ahead?
Yeah, so on from this level onwards, we will continue growing it. I think next quarter, I think an absolute amount we will grow it. I think I would expect anywhere between 550 to 600 crores for the next fiscal, depending on how the projects go.
Okay, and my last question, for the US, you said now outlook appears better with the like plants getting better utilized. So this fiscal we saw US ranging somewhere in say 50 to 55, 56 a quarter. So should we improve significant step up in FY25 and beyond in terms of sales from the US business?
Yeah, well, we are expecting to launch about 25 products in the US. So I anticipate that we would like to grow the business from here onwards. What percentage depends, because it'll be a factor of price erosion in the existing portfolio versus how much traction we can get on the new products. But our goal is to grow the business from here on itself.
So 25 launches for this fiscal?
For this fiscal, yes. Yeah.
Okay. Okay, thank you. I'll get back in the queue.
Thank you. Next question is from the line of Forum, individual investor. Please go ahead.
Hello. Congratulations on the numbers, and I have a couple of questions. So my first question is, which geographies do we plan to penetrate and expand in FY25 for ex-US?
So I think most of the geographies that are present in, it's on our investor presentation and also on the website. I think our biggest territory is the US, followed by the ex-US business is mainly Europe, Australia, Canada, Brazil, and South Africa.
And how do we see this business growing in FY25?
So we don't give a guidance, but generally if you see our ex-US business over the last 5 years, it's had a 20% CAGR, and I think that should continue. The US is a little, in terms of CAGR, it depends, year to year, but this year we've grown it by 10%.
Okay, that's it from my side.
Thank you.
Thank you. Next question is from the line of Vipul Jain from Arihant Capital. Please go ahead.
Hello.
Yeah, hi.
Thanks for the opportunity, sir. So the price realization decline in API, what do you think about that? Is it going to sustain, or this is the?
I think we have a very good quality API business with all regulated market customers. And I've said in the past also, and if you can see that we like to compete at a higher level, we focus more on compliance and better quality. Having said that, there has been some more pricing pressure in the market, so nothing you can do about it. But it's still a very good margin business for us. The API margins are quite high, and it will continue growing.
And also, will this business be led by volume or product mix? How can we expect?
For the API business?
Yes, sir.
API is a combination of both. I think we're growing in terms of volumes as well as new products as well.
Okay. Thank you, sir. That's all.
Thank you.
From my side.
Thank you. Next question is from the line of Abdullikar Purnawala from ICICI Securities. Please go ahead.
Yeah, hello. Yeah, hi. Thank you for the opportunity. So just from an FY25-26 perspective, so R&D was something what you were able to curb in 24. So when you look forward, I mean, what are the few key priorities, when we look forward for growth or in terms of cost optimization, which the management would be targeting for the near future?
Sure. Yeah. So it's a good question. So I think what will happen in R&D wise, historically we see all our approvals and bulk of our R&D spend was on oral solids. If you see that now, it is gradually moved. Part of it has gone towards injectables, complex injectables, derm, ophthalmic, and a little bit of inhalation. So that's what and oncology, sorry. So we've moved towards that. If you see in the future also going forward, the R&D investments, what we've done is we reduced R&D because we cut out some projects which we thought, because the returns have come down in the US market compared to 5 years back. So we've optimized our portfolio, but more share of it is going towards these new areas I spoke about. In terms of cost optimization, not just R&D, but across the board, what we're looking at is, as I mentioned, better utilization of our facilities, higher batch sizes, better volumes, keeping the facilities leaner and better occupied.
Okay. So in terms of the margins, would you like to guide, number for 25, 26 in terms of what is the kind of expansion we should see because of this optimization?
We don't really give a guidance, so sorry about that.
Sure, sir. And sir, one more question on the India business. So this quarter growth was largely impacted because of the acute therapy release. But for the next year or two, I mean, how should we look at your India growth? Would it be in line with the market or slightly ahead of that? And in terms of your field force, are you looking to add further here?
Yeah, so I'll just answer the question. I think from a India business point of view, I said, and I continue to maintain that if the market continues to perform normally, we should expect outperformance, like I said, in almost all our key product therapeutic areas. So that we maintain as long as the market shows some kind of signs of returning to normalcy. So I think we are quite confident on that piece at least. And consistently, I think, outperforming the market in all our therapeutic segments. I think that's something we are quite confident to deliver this year.
Sure, sir. Understood.
And the expansion, sorry, I forgot the expansion. On this year, there's been no manpower expansion in the India business. Just some routine adjustments, but beyond that, there's no actual manpower expansion.
Got it. Thank you.
Thank you. Next question is from the line of Bharat from Equirus Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just wanted to understand on gross margin better.
Bharat, sorry, we are losing your audio. Can I request you to come in a better reception area, please? Due to no response, we move on to the next participant. The next question is from the line of Rashmi Shetty from Dolat Capital. Please go ahead.
Yeah, thanks for the opportunity. Just on the gross margins, you said that, the gross margin would be sustainable. So, in Q4, we did around 75% gross margin, but for the full year, we did around 72%. So which number is sustainable, 72% or 75% what we did in Q4 for FY25?
I said in the past that we'll be happy with our kind of product mix and the territory mix. We'll be happy with about 70% margin. And we have been, more or less, we've been maintaining north of it.
Sorry, sir, I didn't get it. What is the number which you called out?
So I said we will be happy with 70% gross margin, and we have been maintaining that.
Okay, sir. So any geopolitical risk, you are seeing for your supplies or in terms of cost increase, anything in FY25 you would like to call out?
No, I think nothing on the geopolitical side. I think all our facilities are in Baroda and India. So no issues there. I think we have just seen a little bit disruptions in terms of the shipping due to the Middle East. Apart from that, nothing else.
Okay. So my second question is related to the US business. This year, how many launches we have done and what kind of price erosion on an average we have seen?
So we've launched 27 products in the US. I think start of the year we had guided for above 25 or about around that much. So we've launched 27. Next year we expect to launch another 25 or so. Price erosion, it's there. It's tough for me to give that figure because it's very tough to calculate price erosion. But my hazard is it'll be in high single digits or low double digits, somewhere around then. It depends product to product. Some products it's a little higher as well, and some it's more stable.
Okay, got it. But sir, what I want to understand that, we already have 147 products in the US. We have done roughly, $208 to $210 million in the US market. So roughly revenue per product on an average, we are doing around $1.5 million because I understand that we have launched many products and that would gain share in FY25. And plus price erosion is also high single digit, plus we are also adding another 25 products. So don't you think that, we would be actually able to do, double digit sort of growth in FY25? I mean, US, we can see a big growth coming in.
So I agree. With these kind of launches, we should see a decent growth, in my opinion. Having said that, the one unknown or the variable is the price erosion. I don't know how the price erosion is going to fare on some of the high margin products. As you know, that we do like to get higher margin rather than pure volumes, and that's a strategy that we've built in the US business, that we focus more on the profit and the higher prices rather than the margins. So it really depends. If there is erosion in some of the high value products for us, then it eats away a lot of the margins. And we continue to look for short-term opportunities as well. So sometimes there are supply constraints, we do get a bump up. So it's a combination of that.
Okay. Sir, another question, last question is on CAPEX. What would be the CAPEX investment in FY25 and what would be your tax rate?
So as you know, we've come off a large CAPEX cycle last couple of years. So we have no further like brownfield or greenfield expansions. I think at the most what we'll do is within the existing facilities, maintenance CAPEX and capacity debottlenecking. So I anticipate CAPEX should be about 300 crores or so.
Okay, and for tax rate for FY25?
Sorry, I couldn't hear that. What did you say?
Tax rate.
So we'll continue to be under MAT and the tax rate would be about 17%.
Okay, sir. Thank you. That's it from my side.
Thank you. Next question is from the line of Nihar Gupta, individual investor. Please go ahead. Nihar, may I request you to unmute your line and go ahead with your question, please? Nihar, if you can hear us, may I request you to unmute your line? Due to no response, we move on to the next participant. Next question is from the line of Agraj Shah from Tata AIA Life Insurance. Please go ahead.
I hope I'm audible.
So your voice is coming a little muffled. Can you speak to the handset?
Is this better?
Yes.
Okay, so three questions, more like clarification from what we had guided last quarter. So firstly, on the US side, we had kind of mentioned that for FY25, we expect 10 to 15 launches, and now we are guiding more at 25 launches. So what's actually giving us that confidence and what changed during the quarter?
So I think the US is not a question of what gives us more confidence. It's just a matter of, as you know, matter of how many approvals that you get and how many products were launched. We don't always launch if the product is late. We don't always launch it on day one of the approval. So just sometimes it bundles up and we launch them together. So it's just a question of how many approvals that we get and when we launch it. The confidence that we have in launching more products this year is we're seeing the pipeline of products that are pending and what we expect from the target action dates. Also our facilities, as I mentioned, there's no regulatory overhang, so those approvals and the new filings should also flow through.
Okay, got it. And my second question was on the US base. So last quarter, again, we had guided that $57 million was a new base, and this quarter we already reported on a $51 million, but probably you said that there was some one-off kind of an opportunity last quarter. So if you can just clarify that, what changed? Okay.
So on the base business, it's tough to give a guidance what the base business is. I think the best way of seeing it is what's happened last couple of quarters. I think 50 plus is what we're looking at. Q3 was a little higher. We did have some more one-time opportunities in the market. But I guess what we see now could be the base, and then we build it up from there.
Okay. Thanks and all the best. That's all from me.
Thank you.
Thank you. Next question is from the line of Desai from Turtle Capital Management. Please go ahead.
Hi, Pranav. So my first question is, if we go back in time, I think, 3-4 years back, before, certain opportunity and the capex, I think with the 72% gross margin, we were doing 20% plus kind of a operating margin. So, considering that we are doing now complex generics in US market, is it a fair assumption that as operating leverage kicks in, we'll go back to those kind of numbers? I'm not saying which timeline, but directionally, is that a right way to think?
So, no, your observations are right, but you also appreciate the fact that we have, as compared to the period which you are referring to, we have commercialized 4 new facilities, and the cumulative expenses the yearly expenses on these 4 facilities are about 300 crores, including the depreciation. So that the charge is hitting my P&L, whereas the revenues from these facilities are still very small. So as these facilities, more products get approval and the products get traction in the market, I think you will see a better improvement in margin scenario.
Right, sir. I'm talking about when all those facilities are optimally utilized. I'm not saying next quarter or 2 quarters. I'm saying 2-3 years, whenever.
So I think, we hope to be again back to 20% plus kind of margins once we get this traction from these facilities.
Okay. And I think we spent around 2,000 crores on all these facilities. So what kind of asset turns that we were thinking earlier? I think at that time, the US generic market context was slightly different. So given the situation today, have we kind of, changed our assumption on that? If you can cover it over there.
Yeah, obviously. So the buoyancy in the US generic market has gone down. But let's say this market is a little cyclic. If your facilities are compliant, if your supply chain is smart and nimble, we'll keep finding opportunities, and we'll keep seizing those opportunities as and when they present themselves.
So is it safe to assume 2 times asset turn for this facility, or that's on the higher side?
As of now, it's a very hypothetical question, and it's a little distant period question, so I won't comment on it.
Okay. That's it from me. Thank you.
Thank you. Next question is from the line of Vivek Jala from Jala Investment Advisory. Please go ahead.
Sir, I have recently started tracking the company. I basically have 3 questions in regards to the US business. First is, if you could please give some information on how the new launches have been performing in the past few quarters.
So I think new launches have done pretty okay. It depends product to product. As I mentioned earlier, Alembic, we focus more on trying to get the maximum margins rather than getting market share for the sake of getting market share. So it depends on the competitive scenario in each product, and we like to get ready and be there. And when we, as Mr. Bedi said, when we see shortages, that's the time when we ramp up our market share. So it's gone satisfactorily. I think we're waiting and seeing whether we can get more opportunities. We do have a robust supply chain. Mm-hmm. We'll try picking up additional share.
Okay. Thank you. Second question is, how optimistic are we in regards to our performance in US in FY25?
I think we're fairly optimistic as compared to a year back. I think US had come off a massive price erosion, and there's a lot of gloom in the market. Compared to that, I feel a lot more bullish now, especially with the new facilities coming up on stream, the new approvals coming up, and the launches that we have. So while there is pricing erosion and the market is, there is a lot of buying concentration on the buying side, which is driving down prices. But I think there's still opportunities if you run a good business.
Okay. And what would be our focus therapies in US for FY25?
So I think it's a generic business, so we don't go therapy-wise. I think it's just on the capability-wise. And our capabilities that were part of our oral solids, increasingly you'll see more approvals on injectables, on oncology, on ophthalmic, and derm as well.
Okay. And just the last one, are we observing any price erosion in injectables?
Yeah, in the US, you're seeing price erosion across the board, everywhere.
Okay. Thank you. That's all from me.
Thank you. Next question is from the line of Bharat from Equity Securities. Please go ahead. Bharat, may I request to unmute your line and go ahead with the question, please?
Yeah, I'm audible now?
Yes.
Yeah, hi. Thanks for the opportunity and congrats for the great set of numbers. So just wanted to understand on the gross margin part, we have seen almost like 400 basis improvement sequentially quarter-on-quarter. So just wanted to understand what exactly led to this margin improvement.
So quarter-on-quarter is never a good sign of doing a comparison. A whole year comparison is much better, more balanced. And as I said, I think the gross margin hovers at around 70% plus, and we are happy about it.
Okay. And on pricing pressure in the US, so how do you see this pricing pressure to pan out in next year or probably years to come? And how do you see these shortages in the US market? Is it largely led by people are pruning their existing portfolio because of low margin, or there is something else to read out?
But both those questions are very hard to predict because I don't know what's going to happen in terms of the price erosion in the market or the other bit, because it really depends on the competitive pressure where people go, how they lead to how much they drop prices, how aggressive a player is in the market. And shortages also depends on a factor, if someone's supply chain is working, if someone has a regulatory issue. So it's very tough to predict those. But however, we like to stay ready for whatever opportunities we see in the market.
Right. And perhaps this was trying to understand whether these shortages are because of some shortages in the market, because of some regulatory issue, or people are pruning their portfolio.
I think not so much pruning the portfolio. Yes, pruning the portfolio will be there, but I think it's just a matter of one would be the regulatory actions, and number two would be just them being able to manage the supply chain. As you know, the US is large volumes and it's quite dynamic, and sometimes if they're not able to manage the supply chains for whatever reason, then you may see some shortages.
Mm-hmm. And I understand we can't share geography-wise margins, but what I'm trying to understand is what sort of margins will be there for a product where the competition will be, let's say, almost too intensive, like almost like 10 players, whether the margins are below, gross margins are below 40% in those cases, or it will be higher. Just directionally, I'm trying to understand.
It's very tough to generalize. We generally, as you said, we don't give product price, but it's very tough to generalize, right? Depends on how efficient you are on any one product, how much you're backward integrated on, whether you're backward integrated on the API, what kind of scale do you have. So it's very tough to say. It depends product to product.
Actually, I was trying to understand more from the perspective whether these products are turning negative or, let's say, unviable at a gross margin level also, or it is just at a EBITDA level these products?
So we generally don't like to sell anything at a negative margin.
Okay. And last year, this quarter, we have seen that acute has been tepid. What has been the reason for that? Acute therapy in the domestic business.
Sorry, what did you say?
So acute therapy for this quarter in the domestic business has been weak. So what led to it? Is there a particular reason?
Yeah, I think if you look at the base of 21, 22, and 22, 23, you can. I think that gives a clue as to why the base has been weak. So it's predominantly driven by that.
So as far as I remember, in the past years, we had super growth or stellar growth in azithral. So that is the main cause of tepidness for this quarter?
Yeah.
Because the base
not just azithral, I think azithral as well as like I mentioned in the call in my opening statement, the both antibiotic basket and the respiratory basket, and predominantly more gravitated towards the liquid preparations, both antibiotic and respiratory. And yes, Azithral would be a significant chunk of that.
Right. And last one from my end before I move to the queue. On the US business, you mentioned that in the past quarters we have seen some one-time supply. So in the fourth quarter, was there any one-time supply, or it was completely a base business which we have seen?
It was just a regular base business.
Sure. Thanks a lot, and wish you best of luck. Thank you.
Thank you.
Thank you. Next question is from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. Am I audible?
Yes.
Sir, just on the animal health business, there has been a very good scale up. Even fourth quarter, we ended doing almost 34%. So just to understand here, what is it that is driving? Is it more volumes or is it regional expansion? If you could elaborate.
No, it's a mix of both. I think last financial year we have added additional division in the vet business in the livestock segment, and it's a combination of that plus setting up performance which you see. So there's a trend line both in the last 3 years which shows that we continue to perform, and maybe the rate of growth keeps accelerating because it's a combination of both. I think quantitative expansion as well as qualitative operational execution going up.
So the benefit of this new division is now fully reflected into numbers, or we are yet to see the entire benefit in the coming quarters?
We have started seeing good impact on that, but I think it continues to play out even this year as well as next year, I think.
So broadly, how much investment you would have done in this animal health segment till date?
In terms of investment, in terms of manpower?
Both manpower and if any of manufacturing, if you do in-house.
No, so I think the manufacturing is supplied to the existing plants with a combination of internal as well as external third-party suppliers. So there's no additional capex expenditure from that point of view. And in terms of manpower strength, I think like I mentioned in the investor slide, we've added close to 280 people in the business in the last financial year.
Understood. And lastly, on the specialty segment, also year on year, if you look at it, it's 5% growth. While I understand seasonality and higher sales of some select product in the previous year impacted acute, but specialty also has been quite moderate. Any particular reason you would like to attribute?
No, I think if you see both, even the whole IMS performance in the last 4 months has been quite subdued. So I think it's just a factor of that.
In fact, so at the industry level, what do you think what kind of numbers are we thinking of for FY25 at the industry level in terms of growth?
It's very hard for me to predict that, but honestly, we have some internal working, but it's very hard for me to make a comment on the overall industry growth. But like I said, I think I expect this base impact of previous years to get moderated out, or rather most of it has got moderated out in the 23-24. So I expect 24-25 to be more towards a normal year in terms of growth. So I think you can expect maybe anywhere from a mid to high single digit performance for the overall market, I think, next year.
Understood. And lastly, on gross margin, has there been, so as you also witnessed in the API segment in terms of the price erosion, so is that also benefiting us on the formulation side and so partly driving better gross margins? And subsequently, is it sustainable?
No, actually not really, because most of the API we sell to is two separate things, right? This API is all to regulated market customers all over the world. So it's not really it's for one and the other it hasn't. And I said in the last call that some of it is a little lumpy because it had to do with few particular customers, and then there's a little lower offtake. That's one of the reasons.
Okay, sir. Thank you.
Thank you. Next question is from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, hi. Thank you. Pranav, just one question. Your comment on price erosion in the U.S. I mean, high single digit, low double digit seems to be on the higher side. In the backdrop of disruptions and shortages, that most people talk about, how are you reading the scenario? I mean, why are you not seeing better pricing environment? And your comment also, seems like, it's uncertain in terms of how the prices will evolve. So any comments there? How are you reading the dynamics given that, you have a large portfolio and across formulations you are present?
Yeah. So the way I'm seeing the dynamic is compared to about 5 years back, the market is much better supplied than what it used to be. We do have a very high supply percentage, that we orders on time. But the market generally is supplied a lot more players with a lot more product in the market. So that is one of the reasons why I'm saying this. Number two, compared to about 2 years back, I'm saying the erosion is less because about 2.5 years back, we had a whole bunch of that sartan portfolio which we were selling at very high prices due to some short-term benefits. So that has really come down. Having said that, I still see price erosion. It really depends how aggressive the competitors are and to get market share. Number two, on the buying side, nothing has changed, right? Your buyers still remain the same. So they can try negotiating harder whenever they can. It is a buyer's market.
Understood. And just one last one on the US itself. You have launched 27 products last year. How are you seeing pricing on these products, for these new launches? Are they better than what the trend has been in the past or versus your expectation? Or the erosion has been higher, I mean, for the new launches?
Yeah, I think depends on product to product. On some injectables, it was fairly good and much better than what we anticipated. On the rest, we're seeing that buyers do look for sometimes a reliable supply partner, which we've been able to build ourselves up. So it's been a mixed bag. I think by and large, we've been okay. I mean, the portfolio gets to where we thought it would, but it's balanced across ways. So I don't know where it's very tough to predict which ones I'll actually end up with a better margin and which one with a lower erosion.
Okay, thank you.
Thank you. Next question is from the line of Nitin Agarwal from DAM Capital Advisors. Please go ahead.
Hi, thanks for taking the question. Pranav, where do you see the R&D expenses as a revenue settling down over the next 2-3 years?
So as I just said, someone had asked earlier, so for this financial year, FY25, I see that R&D should be anywhere between about 550 to 600 in that range, somewhere around that range.
And this is where you see it settling in general?
No, I think marginally it will keep going up, right? As the business goes up, so we will keep increasing. And I think within R&D, the spends will get reallocated. So as I mentioned, that from OSD, we'll spend a little bit more on injectables, on complex injectables, ophthalmic, derm, so that will get balanced out. And also, part of it will go to the other territories. We've recently been spending a little bit more on the rest of the world territories as well.
And does this change in R&D strategy, does it really imply any large chunks of capex also in the next 2-3 years?
No, on the R&D side, there's no large capex. At the most, it'll just be maintenance capex and equipment upgrades, but no large capex on the R&D side.
No, what I meant is for the products that we're looking to produce, since we're shifting focus now from a new product perspective, does it imply any meaningful expenses on newer capex?
No, not on the R&D side. I think whatever expenses we have to incur, we've already done it in terms of R&D as well as the plant side. So I think bulk of it is already done.
Secondly, Mr. Baheti, how should we think about our overhead costs from here on? I think they've been little volatile. I think after the big plants are all in the base now, should we be looking at what inflation-driven sort of price hikes in our overheads going forward?
Yeah, I think so. I think 23, as I said in the beginning, 23, 24 seems to be a normal year, and from here it could be, I mean, the comparison will be much more easier to do.
Okay. And lastly, Pranav, on the US, the 25 product launches that you're talking about, I mean, are there any assured sort of exclusivity, semi-exclusivity positions for you, that will play out during the year?
No, I think nothing of that sort.
Okay. Thank you.
Okay.
Thank you very much. Ladies and gentlemen, we will take that as the last question. I'll now hand the conference over to Mr. R.K. Baheti for closing comments.
Thanks. I think there are a couple of other guys in the queue. We could not take it just because of we were running out of time. Would request them to send a mail to me, and we'll be happy to respond to you. In the meantime, thank you very much for attending this call as usual. As always, it's pleasure talking to all of you. Gives us a lot of insight and learning, and look forward to your continued support in coming year. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Alembic Pharmaceuticals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.